everybody. I'm Joe Gallimore, Director of Investment Management with Argent Bridge Advisors. Welcome back to Cup of Joe. Now, risk assets had a very good February, but before we get into that, I want to talk for a minute about the connection between stocks and interest rates. Stocks have an inverse relationship with interest rates. So what this means is that when rates are rising, this is seen as a headwind for stock appreciation. And the opposite is true. When rates are falling, that is typically good for stock prices. Now, further, interest rates almost always move in cycles. They trend one way for a while, and then they trend back the other way, kind of like a pendulum. What they don't do is alternate in rapid succession, going up, down, up, down. They don't do that. So let's tie this into where we are right now. Now that stocks have stopped moving in the bad direction, now that rates have stopped moving in the bad direction for stocks with the Fed pausing interest rate hikes, and now we're waiting for them to start moving in the good direction for stocks, the anticipated rate cuts, there's really only one thing that, in our opinion, that a long-term investor should be focused on, and that would be methodically moving cash and short-term safety assets like bonds back into equities. And the final point I'll make here is that when interest rates are cut, not only is that a tailwind for stocks, but what happens to the savings rate on your cash? That goes down too. So when the probability tells you that stocks should go up and the savings rates should go down, what seems like the good move, right? So now back to recent stock market performance. We saw this relationship between stocks and rates play out in the markets in February. Anticipation of the Fed's first rate cut encouraged money to go back into risk assets, aka stocks. So US stocks, small, mid, and large alike, they were all up about 5% for the month, which is pretty good. And emerging market stocks were also up about 5% as well. Now, the boost in stocks, however, seemed to come at the expense of bonds. The bond index dipped about 1.5% in February. But with many bonds and bond funds still yielding over 4% and the expectation of multiple interest rate cuts this year, the return outlook for bonds is still positive. Next, I want to highlight a couple of law changes that everyone should be aware of for the new year. The first is that the gift exclusion limit was raised from $17,000 to $18,000 for this year. This means that you can gift $18,000 of cash or securities to someone without reducing the amount that you can pass along tax-free through your estate. Now, if you didn't follow all that, if you're not quite sure what that means, just ask us and we'll explain. But just remember, $18,000 is the amount that you can gift this year that keeps it clean and easy. Second point is that contributions on the contribution limits on all kinds of retirement plans also went up this year. The most widely used would be accounts like 401ks and 403bs. This includes thrift savings plans. The contribution limit on these went up to $23,000 for 2024. And other types of accounts such as regular and Roth IRAs, SEP IRAs, simple IRAs, they all had their contribution limits go up this year as well, as did the catch-up contribution amount for you folks over 50. So be sure to ask your advisor or your tax preparer if or how you can take advantage of these increases. Well, that does it for our February Cup of Joe. We are here to answer any questions you may think of, so please don't hesitate. And please be sure to check out all our other videos under the Insights tab at argentbridge.com. Thank you very much for watching. We'll see you next time.